Advanced Micro Devices Inc. closed its regular trading session on Friday, July 17, 2026 at $495.76 before ticking down slightly in the after-hours session to $492.10. Because today is Sunday, July 19, 2026, the market is currently closed, meaning these figures represent the absolute baseline where the stock will kick off its next active session. While the headline numbers might suggest a standard tech sector pullback, looking closely at the order flow tells a completely different story, as large funds are quietly building massive defensive positions in this specific chipmaker while simultaneously trimming their exposure to broader semiconductor indices. The crowd believes this company is just a runner-up trying to capture leftover crumbs from the massive hardware build-out, but the ground reality shows institutional buyers treat it as a critical counterweight to prevent a total monopoly in computing infrastructure. If you open up your standard retail accounts, whether you are using the Robinhood app for quick trades or monitoring your broader portfolio through Fidelity Investments, the general sentiment you encounter is that this asset is entirely tethered to its largest competitor. People using standard investing sites see the massive trillion-dollar shadow cast by NVIDIA stock and assume that anything else in the sector is a purely speculative gamble. When individuals look for investment help or manage a self-investing individual brokerage account, they often look at trailing metrics and see a high price-to-earnings multiple that looks terrifying on paper. The prevailing retail wisdom suggests you should either buy the clear leader or stay out entirely. However, looking at the structural reality of how data centers are built reveals a deep flaw in that thinking. Cloud service providers are actively terrified of being locked into a single proprietary hardware ecosystem, because if one company controls the entire supply chain, they can dictate margins across the entire internet. Major tech firms are deliberately allocating a fixed percentage of their hardware budgets to this second platform to ensure healthy market competition, transforming the asset from a speculative technology play into an essential structural component of global digital infrastructure. When analyzing the recent daily swings, the volatility has been driven by rapid shifts in institutional options positioning rather than changes in the underlying business fundamentals. On the Interactive Brokers platform, options volume has shown a major spike in out-of-the-money put selling, which indicates that institutional market makers are comfortable establishing a hard floor under the current price. Trading volumes during the last few sessions spiked well above the 30 million daily average, showing that this is not retail momentum, but large-scale fund rebalancing. When retail traders pull back out during macroeconomic tightening, larger institutional portfolios use the temporary drop to accumulate shares in block trades. If you are executing trades via online investing platforms, you might notice that the daily price action feels erratic, but that is simply the result of algorithmic hedging tied to macro data, like the latest inflation prints and Federal Reserve commentary. For investors executing strategy through an Interactive Brokers account, tracking the net delta exposure of options contracts shows that the asset has built up significant support around the $460 range, making steep drops less likely without a major systemic market shock. The broader sector momentum has been heavily impacted by high interest rates and capital expenditure scrutinization across Silicon Valley. Investors are demanding to see immediate returns on hardware investments, which has caused a temporary pause in exponential corporate ordering. Yet the recent earnings report showed a clear beat on both top and bottom lines, with revenue hitting $10.25 billion for the first quarter of 2026. This beat proves that enterprise demand remains highly resilient, defying the bearish narrative that corporate hardware spend is falling off a cliff. When you evaluate the asset within an automated management context, like Schwab Intelligent Portfolios or a similar intelligent portfolio system, these algorithms frequently rebalance based on pure mathematical risk factors rather than forward-looking technological shifts. This systemic selling by broad automated funds often creates artificial downward pressure, which gives active traders using a Fidelity trading platform or interactive brokers trading tools an excellent window to buy the stock at a discount relative to its long-term corporate earnings power. To understand how the company reached this position, we have to look past the recent market swings and look at its core business design. The company functions entirely on a fabless operational model, which means it designs its high-performance microprocessors, central processing units, and graphics chips internally, but outsources the actual physical manufacturing to external specialized foundries like Taiwan Semiconductor Manufacturing Company. This structural choice is exactly what saved the business from bankruptcy a decade ago, as it freed up massive amounts of capital that would have otherwise been burned maintaining incredibly expensive physical fabrication plants. By focusing entirely on the architecture of its chips, the company created its highly successful Ryzen processors for personal computers and its EPYC server processors for enterprise data centers. This specialized design approach allowed them to systematically strip away market share from legacy giants like Intel, who were bogged down with manufacturing delays and outdated architectural roadmaps. When you look at your positions across different investing sites, whether you manage individual accounts on Robinhood stock trading platforms or maintain long-term retirement holdings via Fidelity IRAs, it is critical to weigh the future catalysts against the prominent macro risks. The most immediate positive catalyst is the accelerating corporate adoption of open-source software ecosystems for hardware management. For a long time, the dominant player in graphics processors maintained a strict chokehold on the market because its proprietary software platform forced developers to stay within its ecosystem. Today, the industry is pushing hard for open architectures, and this chipmaker's ROCm software platform is gaining massive traction among enterprise clients who want to avoid vendor lock-in. If this software adoption hits a critical mass, it will radically accelerate the sales of their Instinct hardware accelerators, creating an explosive revenue stream that the market has not fully priced into the current stock value. On the flip side, the reality of geopolitical risk cannot be ignored when evaluating this asset. Because the business relies heavily on external foundries located in East Asia for its physical chip production, any regional supply chain disruption or trade restriction could instantly halt its ability to deliver products to market. Furthermore, intense competition means the company must continually spend billions of dollars on research and development just to maintain its current market positioning. Investors managing their own portfolios through online investment systems or utilizing a SoFi trading platform must remain hyper-aware of these supply chain dependencies, as even a minor logistical bottleneck can cause wild swings in a high-beta stock like this one. For retail participants using modern apps, whether you utilize SoFi Invest to buy fractional shares or execute complex strategies using the interactive brokers platform, the contrast between market expectations and corporate reality is where the true value lies. The market expects this asset to forever live in the shadow of the largest tech companies, viewing it as a highly volatile proxy play rather than a primary compounder. The reality is that this company has established itself as an indispensable utility for the modern digital landscape. Its chips power everything from the cloud services you use daily to the top gaming consoles and high-end personal computers in the consumer space. As enterprise firms continue to build out their processing capacity, the demand for high-performance, cost-effective chip alternatives will only intensify. To summarize the central insights of this market analysis, the current stock price reflects a high level of market tension, but the underlying corporate engine is operating with remarkable efficiency. While the retail crowd often panics over short-term daily swings and superficial sector comparisons on popular investing sites, institutional players are focusing heavily on the structural architecture, the expanding software ecosystem, and the enterprise demand for open computing platforms. The expectation that this company will fall behind due to the dominance of its largest rival is continually debunked by its resilient financial execution, its consistent earnings beats, and its strategic placement as the ultimate supply chain alternative for major tech firms. As you evaluate your allocations across your chosen individual brokerage, your long-term retirement accounts, or your automated portfolios, recognizing this structural gap between public narrative and corporate delivery remains the ultimate key to navigating this asset. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Like, comment, and share this